My name is Brian Williams. I'm a managing director with Karl Marx Advisors, based out of our Houston office, where I work on oilfield service transactions, both on our investment banking as well as on our financial advisory, restructuring, consulting practice. The oil field has undergone a tremendous amount of change over the last several years. Oil price decline in late 2014 led to a tremendous reduction in utilization and pricing across the oil complex. Just about any service or product sold into the oil field experienced a dramatic decline in terms of demand and also in terms of price. That led to a significant amount of restructuring transactions. Many of those transactions have now run their course through 2016. Many of the larger oilfield service companies that were in some distress went through bankruptcy processes and have emerged, and in many cases have performed quite well since emergence. What we're seeing today in the oilfield market is a large number of smaller private companies, many private equity backed, where the lenders to those businesses really had limited opportunities during the course of the downturn to do anything constructive from a restructuring standpoint. There was not a liquid market for assets that you may seize if you exercised your rights to take collateral. There were very few buyers, if any, for strategic sale processes, and there was really no third-party capital available to come in and help you reduce your exposure to a certain oilfield service company. The times have changed. Beginning in, say, mid-2016, we saw the price of oil start to recover. We saw activity in the oil field begin to recover, and that recovery has persisted up to the present day. It has not been a rapid recovery. It has been a recovery that has seen some price increase, some utilization increase, and many of the participants in the industry, particularly on the smaller end, are now viable businesses again. However, their capital structures still are not correct or right-sized, if you will, for the current status of the business and the expected near-term activity levels in the oil field. So while banks and companies had very few opportunities in 2016 to restructure or sell or to otherwise get out of situations, today you can. And what has emerged are a couple of things. With the recovery in the oil field, we've seen in early 2017, we saw a dramatic increase in oil field service company public equity valuations. Company share prices had risen to levels that incented many companies to look for public offerings as a way to raise capital, and many did raise capital through IPOs. Many existing public companies also went out and fixed balance sheet challenges by offering shares in follow-on equity offerings. What that did was solve the issues for those that were big enough and large enough to solve the problems through the public markets. Public market share prices, however, since late January have declined about 30% as the price of oil has come down, and participants in the industry have seen their business not recover to the extent that they would like. There's been a lot of rigs that have come back to work, but those have been in very specific areas like the Permian Basin. And there's not everybody is a winner in the oil field right now, as they were back in 2013 and 14. So today we're faced with a situation, if you are a lender or a owner of a smaller private service company, where it's time to get something done. There are opportunities now, there are pools of capital that have formed that are ready to provide mezzanine lending or unitranche solutions to come in and maybe take out an entire bank position and provide the incremental liquidity necessary to grow a oil field service company through the upturn in activity where working capital is required, incremental capex is required, and that money is now available. It may be a little more expensive, but it's now possible, and it just wasn't available in the marketplace a year ago. We're also seeing in the oil field today a major trend towards service company consolidation. As the valuations have come down, the public offerings that we saw in the early part of 2017 have slowed, and it's led many companies now to consider M&A alternatives to grow into a larger, more interesting business that could potentially be refinanced more attractively and be a more attractive candidate for a public offering later in 2017. So lenders that were held hostage in 2015 and 16 with really no viable options now today do have options. Borrowers that were in difficult conversations with their lenders and in a continuing cycle of amending and extending existing credit agreements, now have an opportunity to work with their banks on a constructive solution and potentially exit the oil service situations they've been involved in over the last several years.